Okay, great. Thank you, Raleigh, for that introduction. It's great to be here today, and I want to talk about the option strategies that we're using in the current markets, which are working out well. And these strategies have been developed over 30 years, so we've seen all kinds of markets, and these strategies worked very well in the 2001 and 2008 bear markets because we were heavily short during those bear markets. So um, the strategies I'm going to present today have a long history of profitability in any type of market. So um, with that, let's get started. And let's see here. Here we go. So today we're gonna talk about profiting in a down market. We're gonna look at some trade opportunities for this year, and that'll be at the end of the presentation. And I have some short trade opportunities that are good right now to short the various markets that I'm going to show you. And then at the end, we'll have a question and answer session. I'll try to answer as many questions as I can. And then at the end, our offer is um, to give you the Grow manual and our weekly newsletter, and all the strategies that I'm going to discuss today, all the details for those strategies are included in that manual. So we'll discuss that at the end of the presentation. So just as a general overview, um, the S&P is down about 12% from its high. So the stock market in general is in correction mode. It's not in a bear market yet because it hasn't dropped 20%. So we're in what's known as a correction mode right now, and corrections can be difficult to trade either from the long or the short side because the market's typically volatile, um, and uh, we're going through right now, I think what it would be best described as a choppy bottoming process. And we had a very similar market in 2010 and 2011. So um, I'm thinking that 2016 will be similar to 2010 and 2011 with this very choppy price action, big sell-offs, then big rallies. But no real clear trend. So let's just compare this is a price graph for the S&P over the last 12 months. And I'm comparing that to 2010 where it was also choppy. It didn't change much in 2010. So we may be in that correction mode similar to 2010. And here's a price chart of 2011, and this this last 12 months looks pretty similar to 2011. So of course, in 2010, 2011, we did not go into a bear market. I don't think we had that systemic risk today that we had back in 2008. So we're probably going to see a similar price action that we saw in 2010, 2011, very uneven bottoming process, choppy market. So the it's difficult to trade when the stock market is in this correction mode. So what we do is we take long trades in the strongest sectors, and then we take bearish trades in the weakest sectors, and that's worked out pretty well for us. And um, the most important thing you can do in this type of market, or actually any type of market, is whenever you have a profit in a call option or a put option, you always want to leg into a spread trade to protect those profits. And I'll show you how we do that. So regardless of what kind of market condition you're in, the most important thing you can do as a trader is use a stop loss if you're wrong when you buy a call option or buy a put option. But then when you're right and you get a profit, then you want to create a spread trade to lock in that profit. And I'll show you examples of that. So if you have a bullish trade, let's say you purchase a call option and you create a spread trade, that'll help protect your profits if the underlying stock declines in price. And of course, if you have a put trade and you create a spread, then it'll help protect the profits of that put trade if the underlying stock rallies in price. So spreads can profit if the underlying stock increases, stays flat, or decreases. And it's even possible to create these spreads and it'll guarantee a profit for your trade regardless of the price movement of the underlying stock. And we have a lot of these guaranteed profits in our long positions now that we entered um, last year or the year before, and we created a spread trade for our long position, and we will be guaranteed a profit no matter what happens to the underlying stock. So I'll show you examples of that. So um, the Hughes optioneering team over the past 12 months, we've had $1.3 million in closed trade profits, and this is a snapshot of our closed trade record, and it goes back to February 11th of last year to today, and we've had long-term gains of $806,000, short-term gains of $544,000. So these are the I'll show you the trades that we took over the past year. Most of these are spread trades, and we'll just run through these quick. But just to let you know that these strategies have been working pretty well, and we've had 1.3 million in closed trade profits over the past 12 months. So I'll just run through these actual closed trade profits, and a lot of the losing trades in this record are one side of a spread trade. So if we net out both sides of the spread trade, the overall trade was profitable. But a lot of these losses that you see are just one side of the spread, and the spread was ultimately profitable. So we have about 70% winning trades. So that's our closed trade record. And just as a general background, the optioneering team has over 60 years of combined trading experience. We started teaching our option strategies 21 years ago, and I started out with a $4,600 trading account, but during my first 2 years of trading, I made $460,000 trading options, which was more than I had made the previous 6 years as an airline pilot. So that was the beginning of my option trading career. And these are just tax returns from those first 2 years showing that $460,000 in profit. I've won the World Trading Contest 8 times now because I won last year. So I've won the World Trading Contest 8 times, which is more than any other trader. And the World Trading Championship, that's a real money contest, and the results are audited before being posted on the sponsor's website. So last year, I took first place here with a 309% return. And the year before, I took second place with a 339% return. And again, these are real-time returns. So 309% last year, and then 339% the year before. So I'm showing you these profit results. I'm not trying to brag, but I just want you to know that you're learning from somebody that actually trades. So let's talk about um, our trade selection process. We use a very simple 3-step process to select option trades. The first step is to determine the price trend of a stock using the 50 and the 100-day exponential moving average system. Step 2 is we want to confirm the price trend using the on-balance volume line. And step 3 is we want to use what we call the 1% rule to select an option strike price with a high probability of success. And I'll show you an example of that. That's actually a very important part of the trade selection is selecting the strike price, because that makes a huge difference on the probability of your trade being successful. So let's just talk about risks of trading options in general. And what I did was, this is the daily price movement of the VIX index, the volatility index, which measures fear. So every one of these spikes is a market sell-off, and every one of these dips is a market rally. So as option traders, this is what we're facing. If you have bad timing when you buy a call option or when you buy a put option, then that could easily result in 100% loss of your premium. So this is what we face as option traders. And what we try to do with Prime Trade Select is we try to mitigate that risk so we don't have those large losing trades that you can get with options. You can easily lose 100 or even 80% or even 100% of your premium if your timing is off when you purchase an option. So those are the risks we face, and we try to avoid those large losing trades as option traders. So step one is we want to determine the price trend, and we like to use a trend following system that quantitatively measures the buying and selling pressure of the stock. And if we use a trend following system, of course, that allows us to follow the trend instead of trying to predict where the trend's going. So we'd much rather use a system instead of emotional decision making. And we've been using this trend following system successfully for 30 years. And as I mentioned, it worked well in the 2002 and the 2008 bear markets when we had short positions. So right now, we have initiated short positions, and I'll show you our short positions here shortly. Um, so the system's pretty simple. If the 50-day exponential moving average system is above the 100-day exponential moving average, then that stock or ETF is on a buy signal. And if the 50-day EMA is below the 100-day EMA, then that stock is on a sell signal. So pretty simple system. Um, and if a stock is on a buy signal, then we buy call options. And if a stock is on a sell signal, then we buy put options or inverse ETFs. And this trend following system works well in both bull and bear markets. So let's look at a sample trade. This is a buy signal for Cigna, the insurance company, and this displays the daily price movement of Cigna stock. And then this blue line right here is the 50-day EMA. Red line's the 100-day EMA. So we can see back in September, the blue line crossed above the 100-day EMA right here. So once that 50-day crossed above the 100-day, then that stock was on a buy signal. And as long as the 50-day is above the 100-day EMA, then the stock is on a buy. And we like to confirm the price trend with the on-balance volume line, which measures volume flow. And what we look here for, what we look for with the on-balance volume is we just simply want to see this line sloping up. And when the line is sloping up, that indicates that on up days, there's heavy volume, and on down days for the stock, there's light volume. So it kind of measures the on-balance volume, and we like to see this sloping up because that volume flow can help sustain the price up. On a sell signal, of course, we want to see this on-balance volume line sloping down, and that indicates that on up days, the volume is light, and on down days, the volume's heavy. So this is a good confirmation indicator for the trend. Here's an example of a sell signal. This is for the China ETF, FXI, and we can see this was last July, the 50-day EMA crossed below the 100-day EMA. So once it crossed below, then FXI was on a sell signal. and as long as the 50-day is below the 100-day EMA, then that ETF remains on a sell signal. So step two is, as I mentioned, is we want to confirm the price trend using the OBV line. We want to see that sloping up for buy signals, and we want to see it sloping down for sell signals. So let's look at a couple of buy signals we took last year. And um, here's an example. This is for Amazon, and back on July 1st, we purchased the Amazon 330 strike call right here when Amazon was trading at around 425. So this is an example of a buy signal. We can see that Amazon was on a 50, 100-day EMA buy signal as the 50-day EMA was above the 100-day EMA, and we can see the on-balance volume line was sloping up. So that's an example of a trade that we took, and we bought the 330 strike call. Here's another buy for Netflix right in here, and another example, this is for Starbucks. We purchased right in here, and again, you can see Starbucks was on a very powerful up move and an upsloping on balance volume line, which confirmed that price trend. So we bought the Starbucks 40 strike call at 1375. So those are just examples of buy signals that we took where we bought call options when the stock was on a buy signal. So uh, step three in our process is we want to use what we call the 1% rule to select an option strike price with a high probability of success. So whenever you decide to trade an option, um, there could be hundreds or even thousands of strike prices to choose from. So selecting the strike price is just as important as the trade selection itself. And option premiums consist of time value and intrinsic value. So options lose all time value at expiration. So when you buy an option, you're buying a decaying asset. So you always want to keep that in mind. So due to the time decay characteristics of options, when buying an option, we want to minimize the time value because that's going to decay to zero, and we want to maximize the intrinsic value. So what we do is we want to limit the time value portion of the option to 1% of the stock price. And if you limit the time value to 1% of the stock price, what that means is the stock only has to go up 1% for that trade to break even, and you start making money. So um, let's take a look at a few examples. And um, if the stock only has to go up 1% in order for the trade to break even and you start making money, that obviously is going to have a much higher probability of success than buying, let's say, an out of the money option that requires the stock to increase, let's say, 6 to 10% in order for the trade to break even. Because, you know, if you buy a 1-month option or a 2-month option, um, the stock may not make that move in that 1 or 2-month period. And if it doesn't, then you're going to lose 100% of your premium. So we want to stick to the in the money options and limit that time value to 1% of the stock price so that we can start making money if the stock goes up 1%. Here's an example. This is the Starbucks 40 strike call that I just showed you. We bought that at 1375. So when we bought that call, the stock was trading at 53.63. So if you take the stock price of 53.63 and you subtract the strike price of 40, that option had intrinsic value of 1363. So the total premium was 1375. If you subtract that intrinsic value, you come up with 12 cents of time value. So um, in this example, Starbucks stock only had to go up 12 cents, which was about 0.4%, in order for this trade to break even and for us to start making money. So um, that's the best way to select an option strike price is an in the money that only requires the stock to make a very small move in order for you to start profiting. So we like to stick to this rule whenever we're trading options because that really increases our probability of success. So um, this is a call option purchase calculator. We have 6 of these calculators that will calculate the profit potential for an option trade before you take the trade. And what it does is it will calculate the profit loss potential based on various price changes in the underlying stock at option expiration. And in this example, we used a 30% increase in Starbucks stock to a 5% decrease. So this will calculate the profit potential. The bottom row here is the percent return for the option, based on that price move of the underlying stock. So if the underlying stock goes up 30% at expiration, this option will have a 116% return. So this is based on Starbucks stock at the time trading at 53.63. We're buying the 40 strike call at 13.75. So we bought 14 of these calls at that price. So the calculator gives us our profit potential. So we can see that if Starbucks stock goes up 10%, we'll have a 38% return. So even though this is in the money and a more expensive option, we're still going to get a good return if the stock goes up. So, and you can also see if the stock is flat, we don't lose that much. So we'd lose 0.9% if the stock is flat at 53.63 at expiration. So I'd much rather have a 1% loss than a 100% loss because if you purchase an out of the money option and the stock is flat at option expiration, you're going to lose 100%. So I'd rather lose 1% than 100%. So, but I still can get a good return. And so this is the way we like to trade options. This dramatically lowers the risk. So again, in this example, Starbucks stock only has to go up 12 cents and we start making money on the trade. Okay, so we've had a lot of winning trades over the years, and we have a trade management rule. So whenever we have a 30% or more profit in a call or a put, then we create an option spread. We leg into an option spread to protect those profits. And that allows us to hold on to winning trades during sell-off. So right now, we're holding on to our long trades that we created spreads for, and we're profiting even though the underlying stock is going down in price. So spreads have a long position, of course, and they have a short position. The long position profits as the underlying stock moves up. The short position profits as the underlying stock moves down. So it's possible for spreads to profit even if the underlying stock increases, remains flat, or declines in price. So we like to initiate market neutral spreads whenever we have a profit. And if we have a profit in a call option, then we simply buy a put option to help protect that. It's usually an at-the-money put option to protect that profit. And of course, the call option profits if the stock goes up, the put option profits if the stock goes down. Your risk is limited to the cost of the spread. And one of the nice things about these market neutral spreads is there's no limit on the profit potential if the underlying stock continues to increase in price. So um, that's one of the big benefits. So here's examples of put options we bought. We had a profit in Amazon, Google, Facebook, Netflix, Starbucks, and the XLV, which is the healthcare ETF. So we had profits in these calls, so we went ahead and bought these put options to protect those profits. So let's look at one example. This is for Home Depot. We bought the 80 strike call at 10:15, and we had a nice profit in it. At the time, we had a $120,000 profit, 263% return, and this was an option that we had rolled over. That's also part of our trade management, is we roll over profitable trades. So um, what we did to protect that profit is we bought the 110 strike put option at 420. So that was the at the money put. We bought that at 420. And so now we had 45 of the 80 strike calls, and we had 45 of the 110 strike puts. And we have a calculator for the market neutral trades. And what I did is I plugged in this trade into the market neutral calculator. So this is for Home Depot. At the time, the stock was trading at 115. We bought the 80 strike call at 1015, and we bought the 420. And again, these calculators will calculate the profit potential for this trade, assuming various price changes in Home Depot stock. In this example, from a 30% increase in the stock to 100% decrease in the stock. Now, I don't expect Home Depot stock to drop 40%, 80%, or 100%, but I plugged those in here just so you can see the risk profile of these market neutral spreads. So we can see that at option expiration with the spread, if the stock is flat at 115.17, then the spread will have a $2,082 profit and will have 145% return. So we had an existing profit in the 80 strike call. We bought the 110 strike put, and that locked in a 145% return for this spread trade, and that's the minimum return. If the stock goes down, you can see the more the stock goes down, the higher the percent return. Now, I don't expect the stock to go down that much, but you can also see that there's no limit on your profit potential if the stock continues to go up. So if it goes up 10%, then we'll have a 225% return for the spread trade. And as the stock continues to move up in price, our profit potential moves up. So um, you can see that no matter what happens, we'll get a minimum return of 145%. So that's an example of how we like to protect our profits once we have a profit in a trade. And what we'll do is we usually go 3 months out for the put option, and that's usually at the money or close to at the money. And then we'll roll that over 3 months later and buy another put, and we'll just simply keep the call option, buy another put option. So we just roll these over on a regular basis, and that way you can lock in profits no matter what happens. So it's a great way to trade options. We don't have to worry about severe market declines because we're fully protected. We don't have to worry about bad earnings reports or any negative news on a stock, because we simply, once we put this spread trade on, we can just forget about the trade until option expiration, and then at that point we face the decision of whether we roll it over. But it's a great way to trade, very low stress way to trade options. Here's another example. This is for the XLV, the healthcare ETF. We bought 64 of the 50 strike calls at 960, and we had a profit in the call, so we went ahead and bought the 75 strike put at 4 points. And so again, we owned 64 contracts of the 50 strike call, and we had 64 contracts of the 75 strike put. And here's the risk profile for this trade. XLV was trading at 71.44, bought the 50 strike call 960, 75 strike put at 4, and you can see if XLV was flat at option expiration, we'd get an 83% return. Example, That's our minimum return for this spread trade. So it's $1,140 profit, 83% return. If XLV goes up, our return increases. If it goes down, our return increases. So this is a snapshot of a market neutral portfolio, and this was for Cigna, Costco, J&J, Starbucks, Wells Fargo, and Yahoo. So what I did was I took these market neutral spread trades in this portfolio and I used it to calculate the profit potential for each trade, and then I combined those trades into one portfolio just so you can get an idea of the return potential for the portfolio of these market neutral trades. And we can see that on average, if the stocks are flat in this portfolio, we'd have a 277% return. So on average, if the stocks are up 10%, we'd have a 711% return. And now here's where it gets interesting. If the stocks on average are down 20%, then we'll have a 1,282% return for the portfolio. So you can see that even if these stocks have a severe decline, uh, our minimum return is 277%. So, when we were putting these trades on last year, we had no idea that we're going to run into this big sell-off that we've had in January and February. But we always know in the back of our mind that you want to protect those profits, and so we initiated these uh, put option trades to help protect the call option profit. And in this scenario where the market is declining, this has worked out very well for us. We're still profitable on these long trades, even though we've had a steep decline. So this is a great way to trade options. Okay, and this is just a snapshot of market neutral portfolios. One account we had this list the option in this column, and then the dollar profit or loss in this column, and then the percent return. So this snapshot shows we had a $70,000 profit in this account, and in this larger account we had a $199,000 open trade profit. And the thing you want to keep in mind is, even though these stocks may have a steep decline, the portfolio will still be profitable. So that's the example of long trades. Now um, we've been taking short trades during this decline, and um, the on a lot of stocks and sectors, that 50-day EMA is below the 100-day EMA. So that stock or sector is on a sell signal once the 50-day EMA crosses below that 100-day EMA. So um, we have an extra um, filter with short trades, and we've learned over the years that um, with short trades, the 50 and 100-day EMA, that's a shorter term system, and we've learned through experience that you don't want to take short trades with just this short-term indicator. You also want to look at the major trend, and you don't want to take a sell signal against the major trend. In other words, if the major trend, which is the 20-month EMA, if that's bullish, then you don't want to take a short trade when the major trend is bullish, because you may get whipsawed, and it may wind up as a losing trade if you try to trade against the major trend. So for sell signals, we also look at the major trend, and the major trend must be in a downtrend in order for us to take a sell signal. So what we do is we simply look at the 1-month price of a stock, and if that's below the 20-month EMA for that stock, then that's on a major trend system sell. So before we take a short trade, we want to check that major trend, and we don't trade against the major trend. So both trend indicators have to be on a sell signal in order for us to take a short trade. So this winds up with more accurate trades, short trades, and you have fewer of those whipsaw trades when there's counter trend rallies. So let's look at a few examples of short trades that we have for Fortinet, uh, the China ETF, the financial ETF, the biotech ETF, and the small cap ETF. So in this portfolio, um, we have in this portfolio we have inverse ETF trades. So of course, if you buy an inverse ETF, if the underlying sector is going down, then that ETF will profit. This first one, BIS, is the inverse biotech ETF. So if the biotech index goes down, then this inverse ETF will go up. So we have the biotech ETF, inverse ETF, China inverse ETF, financial, and small cap. So we've initiated these trends um, in January and this month, and we're getting to the point where tomorrow we're going to start creating a market neutral spread for these trades. And the way we do that for short trades is we buy a call option, an at the money call option to lock in the profit of the put option. And in the case of the inverse ETFs, we would buy a put option. So we're at the point, especially after today, where we have enough profit now that we're going to start locking in the profits on these short trades. So here's an example of the biotech ETF that we're short, XBI. We can see that the 50-day EMA crossed below the 100-day EMA. The on balance volume line is sloping down. So what that means is on days that this uh, ETF closes up, the volume's light, and on the days that the ETF closes down, the volume's heavy. So that confirms that that volume flow confirms the down price trend. Um, and as I mentioned, we always look at the long-term trend. This is the 1-month price here for the biotech ETF, and this blue line is the 20-month EMA. So we can see that the 1-month price is below the 20-month EMA. So the major trend for this ETF is down, and we can take short signals. Here's the Russell 2000 small cap index, 50-day EMA, the blue line below the 100-day on a sell signal, down sloping on balance volume line, very, very weak index, this small cap. Here's the 20-month EMA for the small cap, and you can see it's really rolled over the last several months. This is the FXI, the China ETF, again on a sell signal, downsloping on balance volume line. Here's the 20-month EMA for FXI, and the monthly price is below that 20-month EMA. Here's one more. This is for Fortinet. That's an internet security company on a 50-day, 100-day EMA sell signal. OBV line sloping down, and major trend is down. So that gives you some good short trades to take right here, because these are very weak trades, very weak price action, and these are the current short trades that we have on. So as I mentioned, we're going to create market neutral spreads by purchasing an at-the-money call option to protect our put option profits and our inverse ETF profits. So this is a snapshot. We have an advisory service where we trade several different option strategies, and I took a snapshot of our market neutral portfolio. These are the open trades listed here. Um, this is our entry price, the current price, and then our dollar profit here, and then percent return here. So the portfolio has a $200,000 open trade profit, 90% average return, and the important thing to remember is no matter how far the markets decline, this portfolio will be profitable. So uh, if you want to look at the current uh, profit results for our advisory service, you can just log on to weeklyoptionalert.com and click the trade results page, and then it'll show you the various um, open trade profits for our various strategies. And then today we're offering a special package, and what's included in this package is it's $39 a month. You can cancel this at any time, but for $39 you get the guaranteed real optioneering winners manual. So this is a manual we wrote, and we go into detail on that market neutral strategy I just showed you. So this manual has all the details on everything we covered today. And then you also get the Optioneering Weekly Workshop newsletter. So these are trades that are coming up each week, and we show you the profit potential for various option trades. And lately, we've been taking mostly bearish trades with this weekly workshop. We've been taking bearish spread trades. So each week we kind of update you on the markets, and we show you some potential trades for that week based on the current market action. So that's $39 a month for this package, and um, you can cancel at any time. And if you're interested, you can go to tradewins.com / grow. So um, if you just click that link, you'll get the information on this package. So um, that finishes my presentation today, and I'd be glad to take any questions, and I'll see if I can pull those up here. Yes, I can see the questions. So let me try to answer some of these questions. I'm going to try to enlarge the this window. Let's see here. Okay. Um, okay. Let's see. Okay. Okay. Here's a good question. Why do you buy options? Isn't selling options a more successful strategy? um, well, that's a good question. That's a great question. We actually will sell options. We have strategies for selling options, but when we sell options, the short option is always covered. In other words, we do covered calls and we do debit spreads. And for a covered call, of course, you buy the stock or you buy the ETF, and then you sell a call option. So in that case, we are selling options, but that option's covered by the stock. And then we also do uh, bullish and bearish debit spreads where we buy a call option and sell a call option, but the short call option is always covered by the option that we own. What we do is sell options naked, because especially in markets like this, you can really get into trouble fast if you're short an option, a naked option, and the market moves against you. Um, let's say you sell a put on a blue chip stock, and you collect 1 point, you collect $100, let's say. If that blue chip stock goes down, you could easily have to wind up buying back that short option for 4 or 5 points, and all of a sudden you have a 300 or 400% loss. So we don't sell uh, options, naked options short, because you can really get into trouble fast. So um, anyway, that I think I answered that question. Let's see if there's any other questions here. Does your system work for smaller accounts? Yes, it does work for smaller accounts. Generally, um, if you have a $5,000 to $10,000 account, you can take 3 or 4 or 5 option trades in different industries, and you can start out, with uh, 3, 4, 5 options in a smaller account, and you can also create those spreads I mentioned with smaller accounts too. Okay, is this a trade alert service? Yes, the weekly option advisory. Um, we send out email alerts whenever we open a new trade or close out an existing trade, and we also keep a closed trade record and an open trade record of all trade recommendations. So we have a full accounting of all trade recommendations. Um, here's a question: do you do credit spreads? No, we don't do credit spreads. We only do debit spreads. And here's another question: do you have short-term trades? And um, I forgot to mention in my presentation that uh, our advisory service and our trades are all longer-term trades. In other words, um, we go out usually 1 to 3 months. Some trades are 6 months. So we go out long term. So this is not the type of trading that you have to monitor the market closely. We found that for the average trader, these longer term trades work out much better than short term trades, because with short term trades, you can really get scared out of your position easily and quickly. So we take the longer term trades. Um, we deleverage our option trades with that 1% rule, which I showed you, and that allows us to hold the trade longer, because we have we usually exit a losing option trade if we have a 20 to a 30% loss. So if you buy these in the money options, we just look at our trades once a day, and if we're near the stop loss, then we start looking to exit that trade, and we'll simply exit at a 20 to 30% loss, which is much better than just sitting on it and losing 100%. So with the in the money options, you can use money management, exit your losing trades, and then of course, if we have a winning trade, then we'll create a spread trade. So, but these are all longer term trades. I found in general, just the average trader just is more successful if the trades are longer term. Okay, okay. Here's a question. When you sell a position very deep in the money, can you get full value, or do you have to sell at a discount? Are people willing to pay 38 for a call that is worth 38? Not sure I understand that. Um, I think what you're talking about here is the spread between the bid and ask. And um, what we do is whenever we trade options, whether we're entering a position or exiting a position, we always try to use a limit order that's kind of halfway between the bid and ask. That way, it cuts down on that transaction cost, that bid-ask transaction cost. Now, we don't always get filled midway, but we may have to give up a little bit, but maybe 5 or 10 cents on the order in order to get filled. But generally, uh, we never get the bid price when we're selling, or the ask price when we're buying. We always get it somewhere in between. A lot of times, it's halfway between. So the stocks we trade are very liquid, and we don't have any problems with the bid-ask, either exiting or entering positions by using limit orders. Okay, uh, let's see. I think I answered most of these questions here. Okay, then. Okay, some of these I'm not understanding it. If you have margin enough, do weekly iron condors once you figure out the trend. I'm not really sure what that is, but we don't do anything that's weekly. In our weekly option advisory, we do trade weekly options, but what we do is if we have a profit on the option, we'll roll it over and we roll over those profits, and then that way, um, we reduce the cost basis of the new option. And we have options that we've had for quite some time and reduce that cost basis and the risk. So we do trade weekly options with the weekly option alert, and we also trade weekly covered calls. And with the covered calls, we usually go for the leveraged ETFs because they typically have a lot of premium, and so we'll buy a leveraged ETF and sell um, a covered call, and we roll those over every 2 weeks to cut down on the commission and the transaction cost. And the same thing with the weekly options. We roll those over, even though they're weekly options, we roll them over every 2 weeks. In other words, we go 2 weeks out. That way we cut down on the commission and the costs. But all our other trades are longer term trades where we're in the trade for several months. And as I said, when you trade longer term like that, we don't really have to look at the market closely. We don't have to monitor it during the day. We just simply look at the end of each day. We see what our positions are doing, how they're doing, and sometimes we'll initiate a spread trade if we have a profit, and other times we'll exit a trade quickly before a small loss develops into a big loss. So um, I think that's it, and I think I've answered most of these questions. Let's see here. Okay, here's a question. Came in late. Can I get a recording? Yes, this will be recorded so you can play it back at your leisure. Um, I think I've answered most of the questions here. You take IV into account, or is that not much of an impact because you go deep in the money? I don't know what IV is, so I can't answer that question. Okay, here's another question. Do you take open interest into account when buying a new position? Um, the option quotes are based on the price of the underlying stock. And just because there's no open interest in an option doesn't mean that, that option is not liquid. In other words, if you're doing options on let's say Facebook, and you do an in-the-money call, if you buy an in-the-money call option, there may not be much open interest for that strike price, but that doesn't really matter because the bid-ask price for that option is changing every few seconds, and it's based on uh, the current price of Facebook stock. So if you use a limit order, um, then that'll cut down on that transaction cost. But typically, like for a Facebook option, the bid-ask spread is very narrow. So the open interest we found really doesn't have any bearing if you're trading very liquid stocks. Okay, I think I answered most of the questions. So I want to thank everybody for being here today. I enjoy doing these webinars because over the years, I've actually learned a lot from the questions that were asked at webinars. I may not know an answer sometimes to a question, so I'll go and investigate it, do some research, and that's how I get a lot of my trading indicators and strategies is from questions that were asked either at live seminars that I've done over the years or webinars. So I enjoy doing these, and um, it was great to be here today, and good luck on your trading, everybody.